Today, we're diving into a real financial detective story. We're on the hunt for what traders call smart money, tracking a massive, and I mean massive, mysterious bet that was placed on one single company. Somebody is betting big, and we are going to figure out why. So check this out. On January 20th, 2026, someone put more than $1.2 million on the table. Now, this isn't some diversified portfolio. This is a huge pile of cash wagered on a single outcome. And here's where it gets really interesting. It's all in on one company, Global Payments, and it has a ticking clock. The whole bet is off the table in just 6 months. This is a high-stakes, high-conviction, all-or-nothing kind of play.
Which brings us to the big question, right? Why? Why this company? Why now? And why do it in such an aggressive way? To get to the bottom of it, we've got to follow the money and really break down the thinking behind this incredible trade.
So to really understand the why, we have to start with the what. Let's dissect the anatomy of this trade, what the pros call a whale trade, because, well, it's so big it makes a splash in the market.
Okay, so here are the nuts and bolts. The investor bought 3,750 call option contracts. Now, for a little over $1 million, they didn't actually buy the stock. Nope, they bought the right to purchase 375,000 shares at a locked-in price. This one move gives them control over stock worth more than $33 million. I mean, that is some serious leverage.
Look, a trade of this size isn't just random market noise. It's a signal flare. It is a deliberate, loud and clear message. This is the footprint of a huge institutional player, what they call smart money, and they are signaling an incredible level of confidence. They're basically screaming that they think something big is right around the corner.
So what on earth was Global Payments doing to get this kind of whale-sized attention? Well, as it turns out, the company had just gone through a massive, massive transformation that totally changed who they were.
For years, Global Payments was, well, kind of confusing. Imagine a brilliant chef running a restaurant that serves both gourmet Michelin-star sushi and like cheap, greasy tacos. It doesn't make any sense, right? That was GPN. It had this high-growth merchant business mashed together with a slow-growth banking business. Investors were confused, so they gave the stock what's called a conglomerate discount. But then, just days before this trade, GPN sold the taco stand to focus on becoming the world's best sushi bar, a pure-play payment specialist.
And the way they did it was just brilliant. A perfect two-step move. First, they divested, selling off their slow old business for a cool $13.5 billion. Then, they immediately turned around and used that money to acquire WorldPay, a global e-commerce giant, for over $24 billion. This wasn't just a minor tweak. This was a complete re-engineering of the company's DNA, turning it into a focused powerhouse. The company's internal makeover, that's our first huge clue. But a smart investor never bets on a company in a vacuum. The next piece of our puzzle is the big picture, the broader economic environment, the weather forecast, you could say. And for the new Global Payments, the forecast was looking pretty sunny.
You had several key things all lining up just perfectly. First, the Fed was expected to start cutting interest rates, which is like rocket fuel for tech stocks. Second, high-end consumers were still spending a ton on travel and hospitality. That's GPN's sweet spot. Third, sticky inflation in services actually helps GPN. You see, since they take a percentage of every transaction, higher prices mean higher revenue for them. And to top it all off, the entire fintech sector was like a coiled spring, just ready to bounce back after a really tough couple of years.
And this brings us to the absolute core of the investigation, the math. Okay, so the company has a new identity, and the economic winds are at its back. But does the stock price actually reflect this new reality? The person who made this bet is saying no. Not even close.
And here's where you can really see the disconnect. When you compare GPN to its new competitors on a key metric like the price-to-earnings ratio, the gap is just enormous. GPN is being valued at only 11 times its future earnings, like it's some slow, boring utility company. Meanwhile, its real peers, like the fintech superstar Adyen, are trading at a whopping 50 times earnings. That is a massive gap in perception.
But pay close attention to the free cash flow yield. GPN is generating cash equal to over 10% of its stock price every single year. That's just an unbelievably high number. A yield like that suggests the market is pricing the company like it's about to go out of business. Our mystery investor isn't betting on a miracle. They're simply betting that the company will be, just okay.
So, in a nutshell, this whole thing is a bet on a re-rating. The investor is saying the market has totally mislabeled Global Payments. It's still pricing it like the old, confusing company when it's actually become this sleek, high-growth machine.
This bet is a wager that the market is going to wake up soon, realize its mistake, and revalue the stock much, much higher.
So we've got the motive, but that still leaves one big question. Why use this specific financial weapon? Why buy complicated options instead of just buying the stock? Well, the answer is all about power, efficiency, and leverage.
And this is where the genius of the trade's design really shines. The investor could have spent over $33 million to buy the stock outright. Instead, they spent just over $1 million on call options. Think of it like this. Instead of buying a house for its full price, you pay a small fee for the right to buy that house in 6 months, hoping its value skyrockets. If the stock hits $100 a share, the stock buyer makes a solid 35%, but the options buyer, a staggering 202% return, all with a fraction of the capital and a clearly defined risk. Okay, let's put all the clues together. We've looked at the company, the economy, the valuation, and how the trade was structured. When you assemble all this evidence, a clear, super compelling 4-part investment thesis just emerges.
And here it is, the complete picture. The structural thesis, the company transformed itself into a pure-play powerhouse. The valuation thesis, the stock is trading at a massive, unjustifiable discount. The macro thesis, the economic environment is providing a powerful tailwind. And finally, a supportive technical thesis. The stock chart just showed it was at a great entry point for a turnaround. All these pillars just locked together, creating a rock-solid case.
So ultimately, this wasn't just some wild, reckless gamble. It was a highly calculated bet on what's known as an asymmetric opportunity. That's just a fancy way of saying it's a situation where the potential upside is significantly, almost exponentially greater than the potential downside. The investor is risking their $1.2 million for a chance to make many times that amount. It's a classic, textbook example of a professional, structured.
And so, the trap is set. All the pieces are in place. The whale has made its move, betting that the market has made a billion-dollar mistake. The only question that remains is whether this will go down as the smartest, most calculated trade of the year or its biggest gamble. Only time will tell.